might have known Boaz Weinstein back in the day for taking on the JP Morgan London whale. And of course, he's been known for many, many years out of the credit world because, of course, he invests in very complicated credit assets. But more recently, he's been known as an activist investor. You have been most recently, after for a while, targeting a series of closed-end funds, very, let's say, aggressively going after BlackRock. There have been lawsuits and, of course, proxy battles. We're actually in the center of a proxy battle right now, with certain funds actually have already been voted on over the last couple of weeks. What we don't know, and what is a very important thing, you've been very vocal on Twitter usually on how these battles are going. You've been pretty quiet. How have the meetings gone? Have you won anything?
So it's always nice to aspire to break news at a conference like this, and it so happens that the fund that has gotten the most of my attention, which is called Big Z, B-I-G-Z, just had the voting close at 11 o'clock. So I can say preliminarily, I didn't count the votes, but they've announced it, that actually all the Saba nominees, there were 7, got more votes than all of the BlackRock nominees, and 4 of our nominees got more than 2 times as many votes as BlackRock, so more than 2 to 1. And when you win an election by 2 to 1, the voters have spoken. You know, we all know landslide is like 60-40, 58-42. If more than 2/3 voted one way, you know, BlackRock can no longer say that they purport to speak for the shareholder and try to create some divisions. The shareholder has spoken. We won. And the reason that there's been litigation, it's been outward, it's us to them, is because they have put in place election rules that would make Vladimir Putin blush.
So let's step back, big step back. This is one fund you said you were voting for today, but there are 10 funds. Mm-hmm. Ultimately, what is it that you want out of this strategy? These are closed-end funds, so you're locking up, or BlackRock has locked up capital for a longer period of time, forever, right, in many of these funds. So what is it that you're trying to accomplish by targeting them? I understand that you target them when they're trading below their net asset value. You want them to bring investors whole. But what's the end game here? You won at one fund. What else do you want?
Yeah, so ETFs, as we all know, can be sold at net asset value, or the market maker can redeem them for net asset value, and then the manager, BlackRock, will go and sell the assets and give back net asset value. Closed-end funds, you're trapped. Many of these funds have no maturity. They could be around for 100 years, 200 years, and so there are periods where the investors don't want them, and for some reason, there isn't a manager more than BlackRock that the investors don't want. It's something personal. I'm not looking to not be besties with Larry Fink. I'm not looking to be besties with Larry Fink. You know, I basically am just looking to make my investors money, and if the discounts are persistent and they're there year after year and you can buy it a literal dollar for 85 cents, you have the power, unlike in normal activism, to turn that back into a dollar, because if you change the fund structure to being an open-ended fund, like an ETF or a mutual fund, or the manager agrees to buy back shares at net asset value, just like Franklin Templeton did this month in 3 energy funds, the investor has a chance to go from 85 to 100. And as you all know, that's not even just 15%, because it's 15 over 85. That's an 18% return. Big Z today is at greater than a 15% discount. And it's a fund that lit its investors' money on fire. Now, I say that, it sounds dramatic. The last 3 years, we've been in more or less a bull market, not for everything. But Big Z has lost more than 50% of its capital from the stock prices going down and from the discounts going up. And so it's lost billions of dollars. And here we have investors resoundingly saying, we want change at the board level. But the part that many of you would be shocked to hear, why I mentioned that quip about Putin, is that they've decided to set election rules such that in order to replace their board, you have to actually get 50% of all the shares. Now, in Big Z, preliminarily, they got about 51 to vote, so we would have needed 50 out of 51. Okay, winning 35 to 15 wasn't good enough. And so that kind of math makes it literally impossible, but ironically, it makes it impossible for them to put anyone else on the board, because they would have to go through their own arcane rules. And so as a result, the BlackRock nominees each sit on approximately 70 boards. 70 different boards. How can they do their job at 70 boards? At JP Morgan, each nominee sits on 1 board. It's horrific governance from a firm that's an incredible firm that actually prides itself in raising money to invest in good governance.
Now, I think importantly, as we've mentioned, this is one fund that you know the outcome for. Yes, it's a big fund for you to be investing in with a large discount, but what about the rest of them? If you were to be on course to lose, how would you react? Do you know anything about those votes?
Right. So I can't announce what's going to happen for the other big funds. Big Z is something like $1.7 billion. It's really large. And that's also why this has captivated the media's attention and also individual investors. There's a lot of money at stake. Going to NAV just a few weeks ago was worth $1.4 billion to mostly mom and pop investors and to our investors, who include mom and pop. We manage money in these very strategies for 3 different state pensions, millions of pensioners. So the results are in limbo, even if we win, because it depends what the judge says. We've taken them to court this year for this election, this election scheme. And last year we did it for a different election scheme, and we won in summary judgment against BlackRock, against Nuveen, and I have a lot of respect for our panelists from the last session from Nuveen. But BlackRock, to be fair, is not the only one, but they are by far the worst. And it's those legal victories that have helped us in order to get good results with other managers who don't want to be on the wrong side of the law. And so that's why this year I was very proud that we won Institutional Investor Activist of the Year back-to-back years. And no closed-end fund activist has ever won it before, and we were voted the best activist according to Institutional Investor.
You're no longer just a closed-end fund activist. You're also a closed-end fund manager, given that you've taken over some funds. And those funds are actually not trading at asset value. So how then do you turn around and attack BlackRock when your own funds are trading at a discount?
So firstly, there's 2 measures. Let's say there's how they performed. How much money did investors make or lose? You mentioned there's a lot of BlackRock funds where we went after. There are 10. 9 of them, the last 3 years, have lost investors' money. 9 out of 10. Think about the market we're in, where the S&P is, even where the Russell is. 9 out of 10 are in the red. Our fund that we've been managing for 2.5 years, that fund has actually made quite a bit of money. And in 2022, the first year we managed it, it was ranked #1 out of 257 funds where the motive was income-based funds, and we came in first. So BlackRock can say, well, their fund trades at a discount too, but what they leave aside, this is the rub, Sonali, is that when we took it over, said to the investors, if you want to get out at NAV or close to NAV, we will let you. We conducted a tender. And then there were more people that wanted to get out, kind of like, looking at it from capturing that discount, and we did a second tender. So we let investors out of 45%. 45% of the capital exited, and we let them out of NAV. BlackRock is not willing to do anything like that.
One critique I've heard you make is the idea of lowering fees here to attract more investment. But for these funds, they tend to run at higher fees than the ETF structure. Would you consider lowering fees for your own funds?
Right. So our fund that we took over in January, the ticker is SABA, is one of the lowest fee funds in the marketplace. It only charges 75 basis points. The other fund is more normal. It charges right around 1%. But it's also you get what you pay for. I think most investors appreciate that if the fund is going to do interesting things, you mentioned credit derivative wizardry or whatever you said in the beginning, and we are doing really neat things in those funds. We're not just putting together a long portfolio and letting it sit. And so I think our fees are actually very modest. It's not for me to say. It's for the investors to say when you look at what you're getting.
Now, I want to read you BlackRock's statement because, of course, they have fought back. They have not let you just attack their funds. They said that BlackRock and the fund's boards remained focused on delivering value for all shareholders through concrete actions such as increased distributions and discount management programs. Saba is an activist hedge fund looking to arbitrage funds to capture quick profits. This attack is not about government's performance or discounts. It is about executing Saba's well-known playbook, buying controlling positions, and forcing short-term changes that harm retail investors to benefit Saba and its hedge fund investors. What is your response to that? And what do you do after these campaigns?
Yeah. When I sit here and think, throw your best at me, Sonali. Like, they send you a question, just please, give me your toughest question. I'm not here to be, we don't have some friendly arrangement. Ask me anything you want. I fear none of their questions because they're so absurd, okay? When they say that we're using some purported playbook to help investors in the short term, where is the long-term pain of making investors money? Usually when you say you have a short-term motive, there's a long-term consequence. Having the funds have investors have a chance to get out at full value, where is the negative in that? And I'm not going to use my words. Okay, ISS, which is independent, okay, which stands to tell the small investor how they should view this kind of rough contest that we're having. Here's what ISS said about this year. Okay, the board is deeply entrenched. A direct intervention remains necessary. It is rare to witness a board so brazenly flout the most basic of shareholder rights in furtherance of their own enrichment. I'll read one more. The board actions are so grave that they would warrant adverse vote for incumbents in an uncontested election. What ISS has said is that even if we didn't run against BlackRock, they would have recommended against their nominees. That is literally how bad it is. And I want to just say, BlackRock's an amazing firm. They manage $10.5 trillion by last account. This might be big to us. This might be very big to our investors. This is tiny, small potatoes. And it'll someday be a case study at HBS of a strategy failure. That for $5 billion of action, of buying back funds at a discount, including their own employees who would get to make that money, including their shareholders, that they would say, look, we actually care about you. We're going to treat you the way other managers are treating their shareholders. They wouldn't have this problem on their hands. They have amazing products, but for closed-end funds, they basically have taken the position, no one is going to tell us what to do, and we're willing to do whatever it takes to squash the rights of the shareholder, which is enshrined in the 40 Act. The 40 Act is there, the 1940 Act, the Investment Company Act, is there to protect small investors. They don't need the same protections in ETFs because you can vote with your feet. You can redeem a mutual fund. You can sell an ETF at NAV. But they are violating the Investment Company Act. Don't trust my words. A judge said it last year, and we won our case.
What is your end game here? Because in addition to, yes, they did support you on the director push, but they did not support you, ISS that is, to terminate BlackRock as the investment advisor. Mm-hmm. Is your ultimate end game to take over these funds?
So we've been in, this is not my first rodeo, we've been in about, 80 campaigns. And across 80 campaigns, only 2 times did the end result come that we took it over. In the first case, actually, the manager resigned. They said, we'll stay on as manager until you can find a new manager. So we don't come into it with that goal. We come into it with the goal of making our investors money. And it turns out all shareholders get to make the same amount of money. They don't have to pay the legal fees that we're paying. And by the way, BlackRock has sent tons of mailers. You saw the Chiron, you saw the graphic. Saba is trying to destroy your fund. That mailer went out 4 or 5 times, robocalls, on and on. I actually received them because I'm a personal shareholder. I received these robocalls and these mailers. And what's amazing, in the case of Big Z, that's the only one I can talk about, they only got 1 out of 7 shareholders to vote for them. I mean, it's just incredible. That's despite so what is my end goal? My end goal is to turn these funds back to NAV and make everyone $1.3 billion, not because I'm some sort of management McKinsey wizard, because NAV is $1.3 billion away.
Has this gotten personal?
I mean, I definitely am feeling it on the stage, right? But no, it's really, you know what it is? I have my pet peeve is, this is going to sound a little corny, is injustice. Okay, everyone has their own. It's abusive, and so I just, having been doing this, having been in 80 campaigns before, I just haven't seen it. We actually decided this past year, in year 2 of this craziness, to launch a fund dedicated to the closed-end funds of a single manager. Okay, we didn't say we're going to pick BlackRock. We looked at the attributes. What are the funds that are at the biggest discounts? What are the funds that have the worst governance? I should say those 2 funds you mentioned that we run, we put in place the best governance. ISS agrees. We put in place governance where you count the number of votes, not the number of whatever that, how do you even know how to describe that you need half of all the shares to be voted in your favor, even if half don't even show up. So all of those things, annual elections instead of staggered elections, it is only personal in the sense that it to me violates, we're so lucky in this business, the amount of money that management firms make. They have $10.5 trillion to do this because they want to trap capital. They're basically blinded by this being long-term capital that cannot be redeemed, and they want to hold on to it. And so, to me, it's like a very noble fight, and we've received, you can just look on Twitter, hundreds and hundreds of positive comments, and basically not one negative comment. So I do enjoy the retail coming along for the ride. Yes, in that sense, it's personal.
So, also, to be clear, this is an investment strategy. This is a strategy that is meant to return money to shareholders. It's not just on concept. How profitable is it? And how big of a strategy has it become? Has Saba really pivoted from becoming a tail fund to an activist fund?
Well, give me a tail event, and I'll be a tail fund manager again. But we've had what have we had, like 40 straight days of the S&P not going down even 0.75%. It is a big business for us. We own $6 billion of closed-end funds. A full third of them are just this single manager, BlackRock, and many of them we think have good governance. They just are at discounts. We don't have a governance issue. So it is quite a big business for us, and I can't really on this stage speak to the returns, but we have an ETF, for example. The ticker is CEFS. It's been around for more than 7 years, and people can plug in how that did versus the 3 other ETFs that own closed-end funds. It's done very well.
How well?
All right. Well, if someone were to plug it into Bloomberg and they put CEFS and then they put the Invesco version or the First Trust version, I think for the last 3 years, and it's held, a lot of it's been in fixed income, which has had a tough time. Those other funds have made between 0 and 2%, and we've made 10%.
So let's broaden out here again, because people have looked at you for credit markets for a long time. When we talk about the closed-end fund strategy, there's a deeper question. It's not really just about closed-end funds. There's a whole push by the private asset industry to push into retail, to push into interval funds, to find new strategies to bring money in. Are all of those funds vulnerable to activists?
So by the laws of depending on the structure, some are not. In the interval fund, generally you only have the right to redeem 5%, so you're getting 5% back per quarter, but you can't. They also invest generally in deeply illiquid assets, so you couldn't just sell Microsoft or IBM and raise the cash. So it is interesting for me, as having been in credit at the forefront of all the innovation that came after 1998 with credit derivatives and synthetic securitization and all of this sort of stuff. And back then, retail investors were deemed unsuitable to own these things. You couldn't own high yields, really, if you were not a qualified investor. And now, whether it's CLO tranches, alphabet soup. And so this has been an amazing boom for the largest asset managers, the amazing managers like an Ares or Apollo that can bring these products, their reputations, and good governance, I should say, because we also see a lot of very good governance. JP Morgan has great governance on their closed-end funds. And we see that there is huge investor demand. The private credit space was a cottage industry a decade ago at less than $250 billion. Now it's $1.5 trillion, and it's growing like gangbusters. So this kind of illiquid credit investing that you're referring to allows the manager to lock up for many years. It's great for their stock price. It may be great for their investors, but we are in a little bit of a zero-sum world. Like, if making loans that are secured, that are safe, that have a lot of asset coverage at 12% or 13% is great for Ares, it probably ain't great for the borrower, especially in this higher for longer world. So just to close on that, just to say, I think people, just even 3 months ago, were really expecting rates to come down and that 13 to go to 12, 11, 10 and really alleviate that pressure. But I think higher for longer, we're headed for some sort of collision course between, if we have that in conjunction with an economic slowdown, we are going to have a default cycle. We are going to see which firms were good at private credit and which were not. Because private credit has been touted as this amazing thing, almost like NFTs or ChatGPT. I mean, what is private credit? You're making loans to smaller companies. I mean, how is that sexy? No, So, but it's very sexy for Ares and Apollo, and I look at it like this amazing force that will have hiccups in the years to come.
Now, one more question for you before I let you go is, we have a major catalyst around the corner, that is the U.S. presidential election. As a massive investor in credit, and also as somebody who looks at volatility very closely, what are you thinking about headed into that election cycle and what comes out of it, how to position?
Yeah, so, it's coming closer every day, and it warrants our attention. And we'll also, if there's a change in the presidency, you'll have a president that people consider as someone that will be more unfettered, let's say, and maybe have scores to settle and have views about how to undo things. And so change generally means volatility. So it's really reflexive to think, okay, if Trump is elected, there'll be a lot of volatility. Now, he also is very interested in the stock market going up, which you usually think about in conjunction with lower volatility. So but might the ways he does that, whether it's a new Fed governor, cause some short-term gain for actual long-term pain, where interest rates in the front end come down, but in the back end go up, and certain firms are affected that way. when I think through that Trump means volatility, the other side of me thinks back to 2017. We had Trump and we had Kim Jong-un, and he was calling him Rocket Man. He was kind of taunting him. And I remember during Rocket Man, it wasn't an Elton John reference, right? At that moment, the VIX hit single digits. The VIX was the all-time, it was at 9. I was crying because I'm a long volatility manager, and the VIX is literally at 9. And so, the Trump presidency is, if it happens, is going to be in many ways unpredictable, so you think there'll be volatility, but let's also remember there was also a lot of economic stability, though maybe because we were in a 0% interest rate world, and now having seen the excess of that and the inflation, maybe we're not going to go back to that world, and there'll be volatility whether Trump is elected or Biden is reelected.
Who's better for the bond market?
Biden.
Why?
Because I think he's less motivated by the stock market and more motivated by what's good for America. On the subject of bonds, I'm not getting that political. Just bonds.
We will leave it there. Boaz, thank you so much for taking all our questions. That is Boaz Weinstein of Saba Capital.